Cameco just told the market that in 2026, it expects to sell its uranium for as much as $96 a pound. But the spot price today is $86.15. I mean, somebody in this equation is wrong, and it isn't Cameco.
Yeah, no, it represents an absolute fundamental disconnect in the structural market. It's just something we rarely see it play out so visibly.
Right. Well, welcome to this deep dive into the latest from the newsletter Uranium Unleashed. Today we are getting into issue number 31.
Which covers the week of July 27th through July 31st, yeah.
Exactly. And just for context as you listen, today is Saturday, August 1st, 2026.
Always good to establish the timeline with how fast things are moving.
For sure. So our mission for you on this deep dive is, well, it's straightforward, but it's absolutely vital if you want to understand how capital actually flows in this sector.
It really is the key to the whole thing right now.
Right, because we are going to figure out why the quote-unquote smart money is completely ignoring the widely reported spot price of uranium right now.
And we're also going to explore how a massive, fully funded structural shift originating in Washington is actively rewriting the rules of the global nuclear fuel cycle.
It's wild, because the events of this past week, they effectively drew a line in the sand, didn't they?
Oh, absolutely. On one side, you have Washington committing historical levels of capital to just, reshape the uranium era.
Yeah.
And then on the other side, you have producers like Cameco entirely upending the pricing narrative.
And the broader retail market barely even registered the shift.
Exactly. But institutional capital, they understand the gravity of these moves.
Okay, let's unpack this, starting with the core numbers. I was looking at the data from the newsletter, and it honestly feels like a tale of two entirely different realities.
It really does.
On the surface, the uranium U3O8 spot price closed the week at $86.15 per pound.
Right, which is virtually flat, week over week.
Yeah, exactly, flat. Now, I mean, it is up almost 21% year over year, but if you were just staring at the spot tape, you see a market that looks like it has been sleepwalking in this tight $85 to $87 band for like the last 6 months.
Yeah, it's been totally range-bound.
But before we go deeper, for anyone listening who might be new to this specific commodity space, what exactly do we mean by U3O8? Like, are we talking about raw rock here?
Not exactly. Think of U3O8 as the baseline standardized trading unit for the industry. You'll often hear it called yellow cake.
Yellow cake, right.
Yeah. Once uranium ore is pulled out of the ground, it goes through a milling process to concentrate it. The result is U3O8, which is then packed into drums.
Okay, that makes sense.
So when we talk about spot prices or term contracts, we are talking about the price of that specific concentrated powder before it undergoes further conversion or enrichment to become reactor fuel.
Got it. So that standardized powder is sitting at $86.15 on the spot market. But then you peel back just one layer, and the numbers get completely wild.
Oh, they really do.
The term price, meaning the price for delivery in the medium future, is sitting at $90 a pound.
Which is the highest level we have seen since 2008, by the way.
Wait, really? Since 2008?
Yeah, it's been a long time coming.
Wow. And the real shocker is even further out. Long-term contracts are actively printing at prices approaching $150 a pound.
Yeah.
I mean, that is a 74% premium to the spot price. I was trying to wrap my head around this earlier, and it hit me.
What's your take?
Judging the uranium market by the spot price right now is like judging the health of a sold-out stadium tour by the three guys scalping tickets in the parking lot. The real money is inside.
Huh. That is a great way to put it. And what's fascinating here is that the spot price has genuinely become the least informative metric on the entire board.
Because in most commodity markets, right, like oil or gold, the spot price is the ultimate truth.
Exactly. But in uranium, the spot market only accounts for a tiny, illiquid fraction of overall trading. It's handled by a very small number of participants. I mean, think about it. A nuclear utility running a multi-billion-dollar reactor cannot risk buying fuel on the spot market week to week. They just can't.
Because if they run out, the lights literally go out.
Exactly. They need guaranteed fuel supply for 5, sometimes 10 years out. So they sign long-term contracts. The tape everyone watches on their financial apps is the tape that actually matters the least to the physical market.
Which brings us perfectly to Cameco's Q2 earnings report on Friday. This was like a masterclass in this exact disconnect.
It really was.
I was reading through these headline numbers and I was genuinely scratching my head. By every traditional Wall Street metric, Cameco completely missed.
Missed big time on paper, yeah.
Right. Adjusted earnings per share came in at 13 cents. The consensus expectation was 28 cents.
A huge mess.
And revenue came in at $573 million against the $592 million expected.
Right.
In any normal market environment, a double miss like that means the stock absolutely chanks at the opening bell.
Oh, usually it gets crushed.
But it didn't. The stock rallied 4.3% in the pre-market. Make that make sense for me.
Yeah.
Why does a stock rally through a massive revenue and earnings miss?
Because the market completely looked past the backward-looking Q2 numbers and focused entirely on the forward-looking guidance.
Okay, so what did the guidance say?
Well, Cameco maintained their full-year U308 production target perfectly intact. They kept it at 19.5 to 21.5 million pounds.
So production is steady.
Yeah. But the catalyst for the rally was their pricing outlook. They raised their 2026 realized price guidance to a band of $91 to $96 per pound.
Wow.
Yeah. That specific adjustment pushes their total uranium revenue guidance up to somewhere between $2.7 and $2.91 billion for the year.
So they essentially grabbed a megaphone and told the entire market, ignore the $86 spot price. We are currently selling our uranium for up to $10 more than that.
They quantified the disconnect. That realized price band is the true reflection of the market right now.
Yeah.
And it is crucial to understand that Cameco is not just issuing a hopeful, optimistic forecast for what they want prices to be. They are reporting the math on a contracted book.
Meaning the ink is already dry.
Exactly. Cameco currently has 230 million pounds of uranium locked into contracts stretching all the way through the year 2030. Utilities have already signed the paperwork.
They've already accepted this new higher price regime.
Because they value long-term security of supply over short-term spot savings.
It is incredible to see it quantified like that. But it immediately makes me wonder if utility buyers, who are notoriously cost-conscious, are voluntarily locking in these long-term contracts at massive premiums. They aren't just looking at today's supply.
No, not at all.
They must be anticipating a massive supply squeeze. Or they see a regulatory wall coming straight for them, which means they're watching what governments are doing.
Yep, the government piece is huge.
And that transitions us directly into the massive structural shift happening in Washington, D.C. right now.
Yeah, the policy stack in the United States has officially crossed the threshold from political talking points to actual funded reality. We are witnessing the forced onshore rebuilding of an entire industrial sector.
This week, the Department of Energy formalized $2.7 billion in enrichment contracts. I mean, that is a staggering amount of capital.
It really is unprecedented in recent history.
We are talking $900 million each to three major players: Centrus Energy, Orano Federal Services, and American Centrifuge Operating.
Right, $900 million apiece.
On top of that, another $28 million went to Global Laser Enrichment, which focuses on next-generation technology.
Yeah.
And specific to Centrus, which you can find under the ticker LEU, they are targeting July 1st for the commercial operations transition of their LEU production.
Which is a massive milestone.
But before we analyze the money, let's pause for a second. We hear LEU thrown around a lot in advanced nuclear discussions. What does that actually stand for, and why is it getting so much attention?
Okay, so ALEU stands for High Assay Low Enriched Uranium.
High Assay Low Enriched Uranium. Got it.
Right. So traditional nuclear reactors run on fuel enriched to about 3 to 5% of the U-235 isotope.
Okay.
But the next generation of advanced reactors, including many of those small modular reactors being developed right now, require fuel that is enriched much higher, typically between 5 and 20%.
Oh, wow. So a lot more concentrated.
Exactly. That is HALEU. It allows reactors to be smaller, run longer between refueling, and operate more efficiently.
Makes sense.
The problem is, historically, the vast majority of commercial ALEU capacity was sitting inside Russia.
So what does this all mean? Let me play the skeptic for a second, because I know you listening to this right now might be thinking the exact same thing.
Go for it.
The bear case here is that this is just government money. Washington announces massive funding programs and drops press releases all the time. Yeah.
Sure, yeah.
And usually that money gets bogged down in bureaucracy. Furthermore, enrichment capacity is insanely complex. It takes a decade to build. Are we getting ahead of ourselves by celebrating these DOE contracts? Is this just another industrial policy mirage?
To push that further, I'd say the skepticism is usually warranted when governments hand out subsidies. But that is the crucial distinction here. The Department of Energy is not subsidizing these companies.
They aren't.
No. Washington is actively buying capacity. They are acting as the foundational customer to guarantee a market.
Oh, that's a huge difference.
Massive difference. To understand the gravity of this, you have to look at the physical mechanics of the nuclear fuel cycle. Enrichment is universally considered the throat of the fuel cycle.
Explain that mechanism for us. Why is it called the throat?
Okay, so when you mine that U308 yellowcake we discussed earlier, it is mostly the U238 isotope, which, doesn't undergo fission easily.
Right.
To make reactor fuel, you have to increase the concentration of the fissile U235 isotope.
And how do they do that?
You do that by turning the uranium into a gas and spinning it at supersonic speeds in a centrifuge cascade.
Okay, spinning it like a washing machine.
Basically, yeah. The heavier isotopes move to the outside, the lighter ones stay in the middle. The effort required to separate those isotopes is measured in something called a separative work unit, or a SWU.
SWU.
Exactly. Every single pound of uranium produced anywhere in the world must pass through a centrifuge cascade and expend SWU before it can be loaded into a reactor.
So it's a massive bottleneck.
A huge bottleneck. And for 20 years, that critical bottleneck was disproportionately controlled by Russian state-owned entities.
Right.
By formalizing these $2.7 billion contracts, the U.S. government is underwriting a domestic front-to-back nuclear fuel cycle at a scale not seen since the 1950s.
So they are legally and financially forcing a pivot in the global supply chain.
Yes. And the ripple effects of that pivot are profound. By intentionally cutting dependence on Russian enrichment, you structurally raise the value of every single non-Russian pound of uranium in the ground.
And every non-Russian SWU capacity on the market.
Thusly, the DOE's actions are becoming a literal P&L line for these companies. That is why fuel cycle equities exhibited such strong relative performance compared to the pure-play miners this week.
And the government's push isn't just financial, right? It is regulatory, too. We also saw the Nuclear Regulatory Commission, the NRC, propose what officials are calling the most comprehensive reactor licensing modernization in decades.
Yeah, that was huge.
They finalized this on July 1st. This move implements the Advance Act of 2024 and Executive Order 14300. It targets advanced reactor licensing, restart timelines, and the deployment of small modular reactors.
It's sweeping reform.
Yeah, the projections say this will save the NRC and the industry up to $1.86 billion.
The regulatory modernization is arguably just as important as the DOE funding. I mean, for 4 decades, the NRC has acted as the single biggest binding constraint on U.S. nuclear capacity growth.
Because the licensing process was just prohibitively slow.
Slow and incredibly expensive. A regulator that is suddenly mandated and equipped to approve reactors faster is, by definition, a regulator that is accelerating future reactor fuel demand.
That makes total sense.
We are witnessing the U.S. nuclear demand curve steepen at a rate that simply has not occurred since before the 3 Mile Island incident in the late 1970s.
So Washington is unbottlenecking the regulatory side, and they're funding the centrifuge enrichment capacity.
Yes.
But a centrifuge is a highly sophisticated multi-million-dollar empty shell if you don't have the raw material to put inside it. We have to look at where the rock is actually coming from.
The physical reality at the mine level is heavily constrained right now, and honestly, it is the missing piece of the puzzle for many generalist investors.
Let's look at Kazakhstan, specifically Kazatomprom. They are the structural supply anchor for the entire globe, right?
Yeah, they are the absolute biggest player in this space.
And this week, they confirmed a massive 10% production cut for 2026. The specific numbers are wild. They're taking their production down from almost 33,000 tons of U308 down to under 29,700 tons.
Right. Removing roughly 3,000 tons of production in a market where utilities are already scrambling for long-term contracts is a staggering supply shock.
Here's where it gets really interesting. Kazatomprom doesn't actually have a uranium problem.
No, they don't.
The uranium's sitting right there in the ground. They have a sulfuric acid problem.
A major one.
Their brand new Turkestan sulfuric acid plant, which was supposed to provide 800,000 tons per annum of capacity, is facing severe delays. I was laughing about the absurdity of this earlier.
Oh, I know the analogy you're going to use.
It's like owning the biggest, most profitable coffee shop in the world. You have a line of customers wrapping around the block, but you have to close your doors at 10 a.m. every day because you can't find running water to brew the coffee. The constraint isn't the beans, it's the water.
The mechanics of how Kazakhstan mines their uranium makes that water analogy incredibly accurate, actually.
Really? How so?
Well, Kazatomprom does not dig massive open-pit mines or send workers underground. They use a highly efficient process called in situ leach mining, or ISL.
Oh, okay. I've heard of that.
So instead of moving the rock to the surface, they leave the rock exactly where it is. They pump a fluid down into the groundwater within the ore body. That fluid dissolves the uranium, and then they pump the uranium-rich solution back up to the surface to be processed.
And the key ingredient in that fluid is sulfuric acid.
100% dependent. The entire geology of their operation requires massive volumes of sulfuric acid intact as the solvent.
Wow.
If you do not have the acid, the chemical reaction does not happen. The rock stays rock.
That's crazy.
Therefore, if you do not have the acid, you do not have the uranium. The world's swing producer is operating at reduced guidance because they are physically out of the required solvent.
So this isn't just a scheduling error.
No, this is not a cyclical blip where management can just ask the workers to run the machines a little faster to catch up. This is a hard, structural, physical limit.
So the biggest producer is choked off.
Yeah.
Right, as the United States federal government is aggressively underwriting a massive steepening of the demand curve.
Exactly.
Now, to be fair to the broader market, it isn't entirely doom and gloom on the supply side, is it? We did get some operational counterexamples this week from other parts of the world.
Yeah, we had some good news.
Over in Namibia, Paladin Energy released their June 2026 quarter results for their Langer Heinrich mine, and they actually delivered.
They sure did.
They produced roughly 4.8 million pounds of U3O8 for their fiscal year 2026, which landed right at the top of their guidance range.
A great result.
And looking ahead, they raised their fiscal year 2027 guidance to a band of 5.1 to 5.6 million pounds.
Paladin's performance is a critical data point for the market right now. It demonstrates what a completed, successful ramp-up of a legacy asset actually looks like.
Right.
Having a Western-friendly producer coming online at scale in Africa provides a much-needed pressure release valve.
Plus, we saw Energy Fuels expand the narrative even further this week. They announced plans to build terbium and dysprosium oxide production capacity.
Which is super interesting.
Yeah. They're taking this integrated mine-to-magnet approach. It essentially folds the uranium bull case into a much broader critical minerals sovereignty narrative.
Expanding into rare earths like terbium and dysprosium is a highly strategic move for Energy Fuels.
Because it brings in new investors.
Exactly. It expands the pool of institutional capital that pays attention to them, proving that the Western critical minerals umbrella extends far beyond just uranium.
That makes a lot of sense.
But if we connect this to the bigger picture and look strictly at the uranium math, Paladin's success in Namibia, while excellent for their shareholders, does not solve the macro problem.
It doesn't.
No. Their fiscal year 2027 guidance implies an incremental global supply addition of roughly 500,000 pounds.
Okay, 500,000 pounds added. That sounds like a lot.
Yep. Now compare that directly to Kazakhstan. As we noted, Kazatomprom is cutting roughly 3,000 tons from their 2026 production.
Right.
When you convert tons to pounds, 3,000 tons is over 6.6 million pounds of uranium coming out of the global supply model.
Oh, wow.
Yeah. So Paladin working flawlessly and adding 500,000 pounds doesn't even come close to closing the 6.6 million pound crater left by Kazatomprom sulfuric acid delay.
It's barely making a dent.
Exactly. The structural deficit isn't shrinking, it is deeply entrenched.
Wow. When you put the math side by side like that, the gravity of the situation is genuinely jarring.
It's inescapable math.
So we have established the massive price disconnect where the spot market is irrelevant and the contract book is printing at massive premiums.
Check.
We have explored the U.S. policy shift, deploying billions to create a legally funded domestic fuel cycle. And we have outlined the severe physical supply shortage anchored by Kazakhstan's sulfuric acid bottleneck. So how does all of this collide in the immediate future? Let's talk about what to watch next week.
The collision is happening in real time, honestly, and there are 3 specific catalysts investors need to track closely over the next few weeks.
I know the Section 232 uranium status report from the Commerce Department is expected in August. But before we get into the impact, what actually is a Section 232 report?
Good question. Section 232 is a specific U.S. trade law that allows the Department of Commerce to investigate whether the import of a certain commodity threatens national security.
Oh, okay.
The market is waiting on pins and needles to see if this specific report will recommend hard, legally binding domestic sourcing rules for U.S. utilities.
So forcing them to buy American.
American or from allied nations. If the government mandates that utilities must buy a certain percentage of their fuel from allied nations, it will instantly re-rate the value of U.S., Canadian, and Australian pounds.
That's massive.
The mere anticipation of this report is already shaping how utilities negotiate their term contracts today.
That is a massive policy overhang. And we are also looking down the barrel of the Q2 reporting cycle for Next Gen Energy and Uranium Energy Corp, or UEC, coming in early August, right?
Yeah, those are going to be critical to watch.
Since Cameco just showed us their hand on realized prices and shocked the market, I imagine everyone is going to be ripping through Next Gen and UEC's disclosures to see if they confirm that trend.
Oh, absolutely.
Specifically for Next Gen, the chatter is all about watching their commentary around the Rook-I development costs.
That's the main focus. So the capital expenditure required to bring new mega projects like NextGen's Rook-I online has been severely impacted by global inflation.
And materials and labor just cost more now.
Exactly. If their development costs come in higher than modeled, it reinforces the narrative that the incentive price, meaning the price required to justify building a new mine, is moving even higher.
Which just pushes the long-term price up further.
Bingo. And finally, you have Kazatomprom's H1 2026 results coming in mid-August.
That is where we finally get an update on the Turkestan sulfuric acid plant timeline, right?
Exactly. The global demand side of the equation has steepened materially since Kazatomprom issued their last guidance.
Yeah.
If they announce further delays to the acid plant, resulting in downward revisions for 2027 production, it would send absolute shockwaves through the term contract market.
Which brings this entire deep dive back to you, listening right now. Why should you care about a delayed acid plant in Turkestan, or a 74% premium on a uranium term contract, or an obscure NRC regulatory update?
Because it all connects.
Because this week's issue of Uranium Unleashed is a masterclass in how to read markets. If you only look at the flashing red and green lights of the retail spot tape, you see a boring sideways market consolidating at $86.
And you completely miss the real story.
You completely miss the tectonic plates moving underneath the surface in the contract books. The institutional money, the utility buyers, the federal government, they have already realized that the spot price is a ghost.
It really is.
It is no longer the price at which the marginal Western pound actually trades.
And the disconnect between that quiet spot take and the aggressive institutional equity market is going to resolve. It has to.
Yeah.
And based on the structural reality of the physical deficit, it has to resolve upward. The physical spot tape will eventually be forced to catch up to the reality of the contract book that has been running ahead of it for the better part of 18 months.
It is a thrilling time to be watching the mechanics of this sector play out. Before we sign off, I want to leave you with one final thought based on everything we've covered today.
This raises an important question for everyone to ponder as we watch these catalysts unfold next week.
Let's hear it.
If the Section 232 report does, in fact, place hard domestic sourcing rules on U.S. nuclear utilities, and the world is already structurally short on Western-friendly uranium because of Kazakhstan's intractable supply issues,
Right.
What happens to the rest of the global nuclear fleet when they suddenly realize they are bidding for a rapidly shrinking pool of fuel against a legally ring-fenced, government-backed United States market?
That is the multi-billion-dollar question right there. And that is all we have for this deep dive. Keep your eyes on those term contracts, watch the policy moves out of Washington, and we will catch you next time.